Hi there, my name is Patrick Oluwadamari Claudius, and in this presentation, I'll be discussing on economic feasibility of investments. So sit back, relax as you follow me through this presentation. Starting with the company overview, right? So Drive Technology is the focus that we are looking at, and in this presentation, I have made some assumption in terms of numbers, and some of the names used here are imaginaries, right? So the Drive Technology is an ICT solution. It's an ICT organization rather that was founded in 2014 by three individuals, namely Oluwafunmilayo Janet, Patrick Claudius, and Folashade Oguntolu. It started with supplying ICT infrastructure such as laptop, scanner, printers, hard drive, pen drive, etc. to offices and schools across Nigeria. However, in 2016, the company dived into software development, and by the Q1 of 2017, the company released its first software solution called School Drive, which is basically a school management system that was created to enable schools manage their activities and for teachers to be able to carry out their task in a faster and more secure format. And of course, this has been deployed to about 36 states across Nigeria and is currently enjoying huge commercial success. Beyond School Drive, Drive Technology has also been able to release three software solutions since it's dive into software development in 2017, and all of these solutions are currently enjoying great commercial success. The company is currently worth about $10 million, and of course the current CEO is Oluwafunmilayo James. Moving on to my next slide, analysis of financial ratio. Of course, analysis of the business key financial ratio, which includes the quick ratio, current ratio, financial leverage, earning per share, return on assets, help us to determine some crucial factor in the business. It helps business managers to know how well the business is doing. It helps investors to know how well the business is doing. It helps financial institutions such as banks who may want to lend money to the business to also know if the business will be able to pay back whatever the business is taking. So we'll be looking at each of these one by one. And so starting with quick ratio, this is a financial tool that provide a way of testing if an organization has enough cash to easily meet up with short-term financial responsibility, and so that's the importance of quick ratio, right? Without having to dig into the inventory of the business, or without having to dispose any of its inventory. So the quick ratio helps to check if the business will be able to meet up with those responsibility. And so in the case of Liverpay is the project that Drive Technology is currently working on. Right, so in the case of Liverpay, the business currently has $2 million in marketable securities, another $700,000 in cash deposit, which is in the bank, and both combined to be 2.7 million. On the other hand, the current liabilities include $525,000 on remitted funds belonging to merchants, right? So we'll get clarity on the nature of the business when we get to the current slide, right? So $525,000 belonging to merchant, another $35,000 in payroll due at the end of the month, account payable of 40,000, debt or 50,000. All of these are imaginary figures that will help us to determine the quick ratio in this regard. So all the current liability total will be 650,000. So using the quick ratio formula, right, so we now know that the Liverpool current ratio, the quick ratio rather, is 4.15, which is current liability minus inventory. In this case, we do not have inventory, so we're then left with current assets divided by current liability, and that gives us 2.7 million divided by 650,000, that amount of 4.15, and that is a quick ratio of Liverpool. So this indicates that the business will be able to meet up with financial obligations, especially the ones that falls within a period of 1 year, right? So another important ratio that we are also looking at is the current ratio. So looking at the current ratio, following the same pattern, right, which is to divide the current assets with the current liability, we also have 4.15 using the QR formula, which is current asset over current liability. And so what is the relevance of current ratio in this regard? So current ratio checks the ability of the business to fulfill its debt liability, right? So especially debt that are within a year. So the company, the current ratio look at that. And so in this case, inventory is also brought into the picture. So current ratio help investors to have insight on how sustainable the business is, and of course looking at it from the peers in the industry. So it's a way of comparing business or a project with other or with similar business and projects in the same industry, to know how the business is doing and to know if the business will not be declaring bankrupt in the near future. And so above average current ratio tells us that the business is in a good standing, while below industry average tells us that the business is likely to declare bankrupt in the near future. And so this raises some kind of red flags. However, we can tell that Liverpool is in a good standing at the moment. Another important financial ratio to consider is the financial leverage. Analysis of Liverpool leverage shows that the business currently has, of course, a debt to equity ratio of 0.23 or 23%, debt to asset ratio of 0.19, 19%, and debt to capital ratio of 0.19, or you can say 19%. Now, what does this help us to do? And so what this does is that it helps organizations to check how to meet up with their long-term debt. It is a combination of multiple ratios, as we have seen, right? So financial leverage is a combination of multiple ratio, and what they do essentially is to measure the indebtedness of the organization or of the business or the project that we are looking at by looking at the total asset and the business equity. So and so in total asset, Liverpool is currently worth $2.7 million, and of course this is broken down to 2.2 million in equity and then debt of 500,000. And so 50%, of course, of out of that equity can be assessed as mentioned earlier, because the 70% is deposited with the Security and Exchange Commission. And so based on the analysis, we can tell, or we can conclude, that Liverpool has a financial leverage that can help the business to mitigate against risk, as the business is currently under leverage, or we can say that the business asset is currently underutilized. The business is not really using its resources to maximum capacity, and this sort of give the business a better standing if should there ever be a need to secure loan from the banks. The current leverage guarantees the business that the business can get suitable loan or facilities in that regard from many financial institutions. Now, looking at earning per share. Earning per share is another key factor that helps to determine how profitable a business or a project is. Of course, it helps investors to know how much they can expect in return for their investment in a business. And so to calculate earning per share is about dividing the total income, which is the net income, over the leftover shares of the company. This is how we can get the earning per share. And of course, if we analyze that of Liverpay, it shows that a net income of $10.5 million, all of these are imaginary figures, was generated in the Q3 of 2022, and the company currently has an outstanding shares of $5.1 million, and it therefore implies that the earning per share is 1.8 if this is divided, if the net income is divided by the outstanding shares, that gives us 1.2 million. So it tells us that for every $1 spent in the business, for every $1 of the business, it means that the shareholder can expect to get 1.82 dollar return on their on every single shares they own in the business. Another key factor to look at is the return on asset. And so what this does is that it helps businesses to know how much profit they can generate from their asset utilization, from the investment on the asset. And so it tells us how efficient a business is doing. It tells us how efficient the organization is doing. It's more like a way of testing the efficiency of the management of an organization in that regard. And so to calculate return on asset is by dividing net income with average asset. And so looking at the analysis of Liverpay net income, which is 10.5 with an average asset of 5.7 million, therefore the return on asset is 1.84, and this tells us that the business is able to generate 4% profit from every $1 of its asset usage. So we can tell that the business is doing relatively fine in this regard. Moving on to my next slide. Weighted average cost of capital and capital budgeting. Of course, this is another key factor to look at in this presentation. And so what this does is that it describes the amount of returns that lenders and shareholders are expecting to receive back from whatever resources they are putting into a project. So for example, lenders will be interested in knowing how much interest they will earn on the capital they push into the project. So if I put $1 million into a project, I want to know how much I can get in returns for my money. So what if I have 2 or 3 competing investment opportunities, and I understand what I'll be getting in return for each of those investment opportunities, this would help me in deciding on which one will give me the best returns that I can put my money into in that regard. So with regards to Liverpay, 50% of the fund came from loan, while 25% is raised from the business shareholder, and it therefore implies that the weighted average cost of capital is 20%. Another key factor to look at is capital budgeting. And so what this does is capital budgeting is actually a method that is used by business leaders to sort of measure the viability of an investment. Is a way of testing if a project is worth spending on, and so it helps in analyzing cash flow movement in and out of the business. It tells how cash is moving from the starting of the project and the subsequent movement of cash or whatever is needed to keep the project running. Essentially, capital budgeting help in deciding on which project to embark on, as said earlier, in the midst of competing investment opportunities, looking at the fact that resources are limited in supply, right? So it's always very good to know which one to spend limited resources on that will generate maximum profit. And so there are quite a number of capital budgeting methods that we will be looking at from this uh, perspective, and one of them is the discounted cash flow analysis. And so what this does is to consider the starting investment uh, and the subsequent amount needed to keep it going, as stated earlier. Another one they use is the present value of the present value, which is to look at, uh, which is to sort of look at the worth of the money that is um, used in the business if it is discounted back to the present date. And so what this does that is it helps business managers to look at uh, the alternative, what they are letting go when they are taking up a certain investment. And so looking from the perspective of Liverpool, there are a couple of options that we had before we decided that it should be Liverpool that we are working on. And we have deployed all of this and realized that Liverpool presents a better advantage in terms of present value, in terms of weighted average, in terms of cost of capital, and all of that. So Liverpool gives us better option that, and that is why the decision to embark on this project is made. Another way they can look at it is payback analysis, and so to sort of this help us to know when we can expect to have recovered every investment put into the business. And this will be looking at in more details in the next slide. And so the overview of the Liverpool project is Liverpool is actually a cryptocurrency payment gateway startup that specializes in processing and accepting payment on behalf of e-commerce platform, in this case merchants. And so analysis or research shows that about 70 million Nigerians are currently involved in cryptocurrency, and this presents a huge opportunity. However, the uh, cryptocurrency is currently not regulated in the country, and so it's not really something that is legally acceptable. Nevertheless, there's still over 70 million people who hold or who participate and trade in crypto on a daily basis. And so rather than having to convert their crypto tokens to Naira, or looking at it from other markets in Africa, so as against converting tokens to um, local currency, with Liverpool, holders of crypto tokens can easily shop with their tokens without having to convert to any tokens. And for this project, our core strategy is to leverage on stablecoin. So with stablecoin, we can maintain the values of the tokens, bearing in mind that the cryptocurrency market is highly volatile. But with the stablecoin, the volatility can be curtailed such that the merchant and the sellers on those merchants will not be affected in the price movement. And so what we are working on is to be in partnership with all of the top sellers in the world, whether they are inside of Nigeria or inside of African markets, right? So as long as we do understand that citizens of these countries would want to usually shop on those platforms. So what we're doing is to give them, to provide enablement for them to be able to buy without having to convert to their local currency, or to be using their local currency to chase the US dollar, which is usually the currency that is acceptable on all of those international platforms. And so using Liverpool, it means that they can now use stablecoin in their wallet. And on the long run, this will be helping the local currency of those countries. So for instance, Naira has always been falling against dollar, especially in recent time. But with what Liverpool is bringing on board, Naira can sort of gain competitive advantage against the US dollar. The the rate at which the society is in demand for dollar will drastically reduce. And so this is the unique advantage and unique value proposition that Liverpool is bringing on board in those regards. Project NPV, IRR, and payback period. So in order to be able to prepare the net present value, internal rate of return, and the payback period, I have made a couple of assumptions, and this includes interest rate of 14%. I'm also assuming on equal cash flow that happens throughout the year. And so the Liverpool project current NPV is, of course, we're starting with an investment of $2.9 million, right? So using the NPV formula, I was able to get a total NPV of 2,316,500 using Excel sheet. I was also able to get internal rate of return of 42% on that. With regards to payback period, I was able to discover that starting with an investment of $2.9 million, the business will be able to recover this amount of money on the shortly after the second year, right? So which is the second year, and from the first month of the third year, the business should have been able to attain profitability. And so if the business span over the period of 4 years, the business will start making profit from the beginning of the third year upward. With regards to recommendation, so some of the things that I have discovered, especially in the course of my studies so far, is the fact that the business will need to improve on the path of asset utilization. The current analysis shows that the business has great potential, considering the market performance, how the business has been able to generate so much money within the shortest period. And so this tells that there's huge demand for what the business is offering, and so the business will need to go all out in terms of publicity, expand to all other markets, ensuring that there's presence in other markets across Africa, so that it can take full advantage of the market to increase revenue. Another key recommendation would be to invest in media and publicity, of course, to improve brand awareness. This, I strongly believe, will help the business to sort of have better presence across every market where it operates. It will help users to have more trust in the business. A lot of other people will be more interested in using the business. This would also help the business to have more partnership with e-commerce platform who will be willing to integrate with the business, because essentially the more merchant the business is able to integrate with, the more market the business is able to sell, the more transaction the business is able to process, and on the long run, the more revenue the business will be able to generate. Another thing that I would also be recommending is for the business to leverage or to use its resources to maximize its financial leverage, which is currently sitting there without being used, by taking up more loan, so that the business can do more. There's a lot to be done within the Africa market, that the business, if the business can take up more loan, the business will be able to expand more, be able to take up more projects, expand the scope of the project, rather than limiting the scope to payment solution. The business can also expand the scope and increase the use cases so that it covers several other aspects, which may include the ability to have merchant directly listing on the business, So this will mean the business increasing, of course, its infrastructure that would have merchant to have a direct market on the business platform. So of course, business will need to have infrastructure that supports this massive traffic when it comes. And so one my recommendation would be for the business to bring up more finance that will provide a means to enhance infrastructure and scale up the team so that the business can ultimately generate more revenue in this regards. Uh, and here are the references used to prepare this slide. I hope that I have been able to, you know, convince and to provide necessary information uh, with regards all of the financial ratio, internal rate of returns, and every key financial um, instruments that will be of benefit to business managers, investors, lenders, and every other stakeholders when deciding on the best projects to embark upon. Thank you.